Great to have you join us, Samladi Williams. First off, let's look at what's happening in the markets, starting with Africa. See, sentiment is positive at intraday. The NGX index was down, though at about 0.25%, continuing yesterday's bearish sentiment, while South Africa's JSE jumped 1.4%. Elsewhere, investors in Egypt are still riding on the interest rate hikes made yesterday by the central bank. The EGX 30 traded strongly in the green at intraday, up 3.22%. Kenya ended Monday's session positive. And markets we track in the Middle East are also trading in positive territory. In the UAE, Dubai's main index edged up 0.25%, while the Abu Dhabi index was down by 0.41%. Elsewhere in the region, the Qatari and Saudi Arabia markets both traded in positive territory, up 2.31 and 0.10%. And the European Union is considering joining the US and UK in banning Russian oil imports. That would be a major shift, as EU countries had previously been against an embargo, since many of them depend on Russian oil. We'll have Chelsea Delaney joining us from Berlin. Great to have you, Chelsea. So why are the EU countries changing course at this time?
Well, I'd say it's probably a little too early to say they're changing course, but EU leaders are certainly warming up to the idea of banning Russian oil imports. Keep in mind that the US and UK have already done this, but the EU had been pretty resistant up until now, simply because they need Russian oil more. It accounts for about 25% of all EU oil imports. But EU leaders also seem to be acknowledging now that the sanctions they've implemented so far against Russia just aren't enough. So freezing oligarchs' assets, cutting Russia out of the SWIFT payment network, even freezing those central bank reserves. They have certainly devastated Russia's economy, but cutting off Russia's energy is the ultimate economic weapon here. Since the war began in late February, the EU has been paying Russia almost 20 billion euros for that oil, gas, and coal. So money is keeping Russia and its war efforts running. So Eastern EU members like Lithuania, Poland, the Czech Republic in particular are behind the push to stop EU oil imports from Russia. But Germany remains one of the countries that is against an embargo. But even for Germany, its position does seem to be shifting. And they're saying now that while it is opposed to an oil embargo from Russia, that position isn't set in stone.
Not an easy U-turn there. But, many EU countries are reliant, on Russian oil. What are the options here?
So as I said, in total, the EU gets about a fourth of its oil from Russia, but that really varies drastically by country. Germany gets about half of its oil from Russia, Bulgaria nearly 80%, but other countries like Romania or Ireland or the Netherlands are much less dependent on Russian oil. So that exposure definitely varies across the bloc, but in general, an embargo would take out a big chunk of oil supply. Russia's a major, one of the biggest oil suppliers in the world, and that would mean less oil and definitely higher prices across the board. EU governments are already working to dampen the impact of both higher oil prices and the increase in natural gas prices, which has been much more dramatic. Italy, for example, is imposing a 10% tax on energy producers and using that money to help families and companies that are struggling with these rising energy costs. Germany has proposed a temporary rebate on petrol prices. So if the EU does decide to ban Russian oil, governments likely will have to do more to subsidize oil prices so that consumers and companies who are already struggling with inflation aren't hit too hard.
Yeah, we can see the impact already, but how's it looking for oil prices?
Well, the proposal already has sent oil prices rallying once again this week. Crude prices are up about 10% over the past 2 days. They are up almost 50% for the year. The question facing the oil market is, can other oil suppliers step in and fill the gap left by Russia? There already is a global effort underway from the likes of the U.S., the White House here in Europe to get other oil producers like Saudi Arabia, the UAE, or even pariah states like Venezuela or Iran to increase their oil production. But so far, those efforts have been a bit mixed, in part because of other issues not related to the Russia-Ukraine war. Production at Saudi Arabia's facilities, for example, has been disrupted by attacks from Yemeni rebels. Other major oil-producing nations are struggling to raise production after years of underinvesting in maintenance and upkeep. So there really is no easy and quick solution to replacing Russian oil.
Definitely, definitely. But how are the markets looking in Europe?
Well, the prospect of a Russian oil embargo is a major concern for investors here in Europe. We've seen the DAX here in Germany falling over the past 2 days on these concerns. And that's really because this is a major threat for inflation. Inflation is already running at really the highest rate in decades here in Europe, in the US, around the world. If Russian oil prices, if this Russian oil embargo causes prices to go even higher, that's going to put even more inflationary pressure on these economies as well. We're looking at, consumers, businesses having to potentially cut back spending in other parts of the economy. So that is a major concern. We've already seen central bankers, particularly in the U.S., say that they could begin to really accelerate the path for monetary policy tightening. So a lot of this money coming from central banks has been the reason why we've seen stocks at record highs once and again. So this is something that could definitely start to undercut the market rally. Investors, certainly here in Europe, are watching that closely.
Quite an interesting relationship between equities and oil markets. All right, thank you so much, Chelsea Delaney, right there in Berlin. Moving on, we see shares in Asia Pacific were mostly higher as Hong Kong listed shares of Alibaba soared after the firm announcing upsizing of its share repurchase program from $15 billion to $25 billion. The Tuesday market close in Hong Kong, shares of Alibaba listed in the city were up 11.2%. Hong Kong's broader Hang Seng Index led gains among the region's major markets as it climbed 3.15% to 21,889 points. The Nikkei 225 in Japan jumped 1.48% to close at 27,224 points, while the Topix Index climbed 1.28% to 1,933 points. Mainland Chinese stocks closed mixed as the Shanghai Composite edged 0.19% higher to 3,259 points, while the Shenzhen Component dipped 0.49% to 12,318 points. South Korea's Kospi advanced 0.89% on the day to 2,710 points. In Australia, the S&P ASX 200 gained 0.86%, closing at 7,341 points. And over to the U.S. to see stock futures rose as Wall Street locked, and we see the rebound from a down session while traders weighed Federal Reserve Chair Jerome Powell saying the central bank is open to higher rate hikes to combat rising inflation. Futures on the Dow Jones Industrial Average rose 132 points. The S&P 500 futures and Nasdaq 100 futures both gained about 0.3%. Investors continue to watch the situation in Eastern Europe, with President Joe Biden saying Russian President Vladimir Putin's back is against the wall as the war with Ukraine nears stalemate. And the Bank of Ghana increased its benchmark interest rate for the second time since November, raising it to a 3-year high of 17%. Saying already high inflation was being worsened by the Russia-Ukraine war. The Monetary Policy Committee lifted the rate by 250 basis points, which exceeded the median estimate of 7 economists in a Bloomberg survey, which expected an increase of about 100 basis points. Policymakers are forecasting high inflation in the near term, with price growth expected to fall within its 6 to 10% target band within a year, as the combination of tighter global financing conditions, sharp pressure on the exchange rate, and elevated inflation pose some policy challenges. The move comes as the CD has been trading close to record lows against the dollar, and inflation accelerated more than expected in February to 15.7%, a near 6-year high. And as inflation continues to bite globally with rising commodity prices due to the war in Ukraine, central bankers are trying hard to fight inflation without hurting economic growth, with the U.S. Fed raising rates and talking about more aggressive rate hikes ahead. what will be the potential impact on African economies. We have Aquara Norma, investment analyst at Deutsche Partners Holding. Great to have you on the program.
Good afternoon, Ladi. Thank you for having me. Okay,
Yeah,
looking at the rise, yeah, thank you. Looking at the rising global inflation is really affecting both African economy and globally. And in the Nigerian markets, we are seeing a very high increase on inflation rates, and we know that the U.S. Federal Reserve has a major influence on global economy, and whatever decision that they take has a way of affecting the economy generally. And as you can see now, as they increase their interest rates, most African and emerging economies are mostly import dependent. And as this is going on right now, we can see that we're going to have a more price surge in imported goods, because most developed economies has a comparative advantage over us, the emerging economy. So it's affecting us generally. And due to the rising inflation rate, Nigeria has an increased inflation by February of 15.7% from what it was initially 15.5%. So it's affecting the Nigerian economy, and not just Nigerian economy, the African economy generally. So it's something that the federal government and the CBN is actually looking up to curtail in order not to have more impact on us. And we can see that the reason why Jerome Powell did that is to bring price stability into American families, because they're already developed. And we are mostly dependent on their products, because they have more comparative advantage over us, and we use most of their products. So it's having a negative impact on.
quite interesting. But, we've seen Ghana, Egypt, raise rates. But you see the Central Bank of Nigeria, we maintained, rates yesterday. What do you make of that?
Okay. We can see that the interest rate is affecting Nigeria mostly because the inflation rate is on the increase. And as it's on the increase, we're already on a trajectory path from the recovery of the impact of the COVID-19. So I believe the reason for the MPC not to increase the rates yesterday during the meeting, which most of them voted that it remains at 11.5%, and the liquidity ratio remains 30.0%, the cash reserve remains 7.5%. They actually did this. I believe they're doing this because they don't know the impact of what the increase will be on the economy already, because we are already on a path to recovery. So increasing it it may not do us any good at the moment, but looking at it on the long run, it might have a positive impact on the economy. So as the global economy unfolds, and which is this is usually influenced by the face-off between the Russian-Ukraine crisis. So as it unfolds, I believe they will make the right decision on that already.
Right, quite a tough time for central bankers globally with rising global inflation. All right, Norma, thank you so much for coming on the program. Investment analyst, Deutsche Partners Holding. Was great having you.
Thank you, Ladi.
Coffee prices have risen by 69.23% over the last year, from an estimated $2,600 per ton to a peak of $5,100 per ton in February, and currently trading at $4,600 per ton. Given that coffee, is a household food item, this price increase is sure to have inflationary repercussions. Let's talk to Lawrence Messi, analyst, financial derivatives company. Great to have you, Lawrence.
Thanks for having me.
Yeah, so there's quite a jump in coffee prices. What do you think is causing this astronomical surge?
Well, it's largely due to the weather conditions that are affecting the world's leading producers of coffee. So in Brazil, they experienced what is called the frost in late July last year. So that has really constrained farmers from producing coffee, and they experienced a lot of shortages going forward. Then the second factor leading to this increase in prices is the supply chain issue, that's shipping routes. So there's a combination of two things. there's an unavailability of ships, as well as an increase in freight charges. So these two factors have combined to make the shipping of coffee to other countries that need it a bit of a hassle. And then thirdly is increase in fertilizer costs, especially experienced by both Vietnam as well as Brazil. So when you combine these three main drivers, that's the weather challenges, the shipping constraints, and the increase in fertilizer costs, that's what's attributable to this astronomical rise in coffee prices.
Quite interesting. Everything on the way up. And Uganda has been in the news recently, first for withdrawing from the International Coffee Organization, and more recently for the 20% decline in its coffee exports. How do you expect this to impact, global coffee supply chain and prices?
Well, current research, according to data on Business Insider Africa, shows that Ethiopia and Uganda are the largest producers of coffee in Africa. Together, they account for about 75% of African coffee production. Uganda alone accounts for somewhere between 25 to 32% of African production. So now, to give you a bit more context, when the supply shortages from Brazil and Vietnam occurred, the Western world decided to switch to African suppliers for coffee. So when a major player like Uganda is experiencing a 20% drop in output, then there's only one thing that can happen then, and that's for further increases in coffee, because large corporations, maybe like Starbucks, could see a shortage in supply, an increase in orders, but no service coming through. And that would only cause to increase the price of coffee-related products and coffee itself.
Right, and we see demand for coffee in Nigeria is growing, but Nescafe holds like a 60% market share in coffee sales in Nigeria, with its production being done in neighboring Cote d'Ivoire, and actually with non-Nigerian coffee. And it also shows that Nigeria produces about 1,887 tons of coffee, while Uganda, Cote d'Ivoire, and Ethiopia are Africa's largest producers and exporters. So what is responsible for Nigeria's lagged performance in coffee production?
Well, it's all about the structure of the coffee industry or coffee supply chain in Nigeria, as you would have it. So from planting to marketing and sales to value addition, there's a problem structurally. So starting from planting, a lot of farmers have actually left their coffee land plots. This is because, well, some of them are old, farming practices have not been renewed, and also because of pricing, farmers are not attracted or incentivized to plant coffee. So despite there being massive coffee production potential in about 10 states, we're seeing that farmers are not just large in planting coffee. The second thing has to do with marketing. There isn't any centralized exchange for coffee in Nigeria, but there is some hope. The Senate has passed a bill for the National Tea and Coffee Development Council. Whether they will be effective in carrying out the duties of bringing out coffee is yet to be seen. But for now, there's no centralized exchange, so there's no marketing in the value chain and no distribution for farmers. And then lastly is the quality of the farming practices. There's no washing and milling is largely inefficient, so it doesn't attract foreign buyers of coffee. And so all of these factors combined is what's responsible for the lack of participation and the lack of production of coffee in Nigeria.
Right, Lawrence. Well, we need to find at least one commodity to actually profit from, at this point. All right, Lawrence Messi, thank you so much. Analyst, Financial Derivatives Company. Thank you for coming on the program.
Thank you very much.
All right, now talking about fertilizers, you see farmers worldwide are feeling the sting of sanctions as the Ukraine war has sent fertilizer prices soaring to new all-time highs, prompting concerns over global food shortage. Fertilizer prices last week were nearly 10% higher than the week before, according to Green Markets North America Fertilizer Price Index, the highest price point ever recorded. Prices are now 40% higher than a month ago before the invasion of Ukraine. Surge in fertilizer prices reveals how dependent many of the world's farms are on Russian exports Countries already afflicted by food insecurity now risk further production bottlenecks and food shortages as at the worst possible time. And Egypt has fixed the price of unsubsidized bread amidst a global surge in wheat prices since Russia's invasion of Ukraine. The move comes after a war shut off the access to cheaper wheat from the Black Sea region, particularly affecting exports to the Middle East and North African region. Egypt is the world's biggest wheat importer, bringing in about 60% of its grain from overseas. Russia and Ukraine accounted for 80% of the country's imports last year. And Egyptian Prime Minister said the price of commercially sold bread at 11.50 Egyptian pounds a kilo, which is about 49 British pence. The new fixed price for flat, round baladi bread weighing 90 grams has been set at 1 Egyptian pound. Concerns about supplies of wheat had already pushed up the price of bread, which is a food staple in Egypt, as much as a quarter in some bakeries, to a 1 Egyptian pound 25 a loaf, while flour prices were up about 15%. And the Central Bank of Nigeria says it will continue its development finance intervention to support the growth of the economy. CBN Governor Godwin Emefiele made this known while briefing the press at the second Monetary Policy Committee meeting yesterday in Abuja. Take a listen.
But in terms of advice, I think it's important that we reiterate the fact that the Central Bank of Nigeria remains a development finance-oriented central bank. And it is normal, it is very, very normal for an emerging market or developing economy to deploy development finance tools through interventions to support the growth of the economy. Let's not forget, about 2 years ago, monetary policy said that our new thrust will be price and monetary stability that is conducive to growth.
Approved a $750 million budgetary support for Kenya as the East African nation qualified for the World Bank's development policy operations, which lends cash directly to the Treasury for budget support instead of financing specific projects. The loan, which comes with an annual interest rate of about 3.0%, is the second tranche of a credit facility initiated in 2020, and the first tranche was disbursed last June. Reforms tied to the loans include the establishment of an electronic platform for public procurement to foster transparency and reduce opportunities for corruption. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye for now.